Has your low interest rate been holding you hostage? Is it keeping you from making your next big move? This real estate phenomenon known as golden handcuffs effectively traps homeowners who want or need to sell but don't want to lose their low mortgage rate. There's a lot to unpack, so stick around and find out how selling your home isn't as straightforward as it used to be and how you can best navigate this unprecedented market scenario coming up next. Welcome, I'm Jason Fiallo, your Virginia relocation guide and proud lifelong resident of Virginia. Today we're diving into something that I know is on the minds of many of you. It's the whole idea of golden handcuffs. This is a tricky spot where you have a historically low interest rate and are considering a move, but are reluctant to sell because it means losing that rate, among other reasons. If you've been wrestling with this, you're not alone. I'll start by sharing how we got to this position, then break down the pros and cons of selling versus keeping your property, and finish with options and strategies based on which direction you should choose. Let's get into it. Picture this. A few years back, jumping into the housing market felt a bit like striking gold. The allure of historically low mortgage rates opened doors for many to home ownership, doors that in a different financial climate might have remained closed. This led to a flurry of purchases, quickly escalating home prices where multiple offers became standard. The uptick in demand forced many buyers to compromise on things like house type, price, location, and property condition, eventually leading some to have buyer's remorse. Fast forward to today, and the narrative has shifted. Property values have soared in most of the country, and mortgage rates are more than double where they were just 2 years ago, keeping homeownership out of reach for many would-be buyers. In addition, markets like Northern Virginia and similar major metro regions are leaning heavily and favorably towards sellers despite prices and rates. Yet, here's where the golden handcuffs click into place. On one hand, the potential for significant returns on your investment is incredibly attractive. On the other, the prospect of venturing back into the market as a buyer, facing higher interest rates and a competitive landscape, gives pause. It's a complex scenario layered with both opportunities and obstacles, driven by a market that's as unpredictable as it is promising. Stepping into a seller's market now is like stepping on stage where the spotlight is firmly on you. Demand is sky high, and properties in highly desirable areas often sell well above their list price. This unique moment presents an opportunity not just for significant financial gain, but for life-changing moves. Dreaming of a home with more space for your growing family, a peaceful retreat closer to nature, or even a vibrant spot right in the heart of the city? This could be your chance. But the benefits extend beyond just location or space. There's the financial angle to consider, using the equity you built up in your current home to soften the impact of your next purchase. In a market like ours, that equity can be substantial, offering a buffer against the higher rates we're seeing today. Yet, it's not just about the numbers, it's about what those numbers enable you to do, whether that's reducing your new mortgage, expanding your search area to areas you thought were out of reach, or even affording you the luxury of relocating to a market with a lower cost of living and pocketing some of the sale proceeds. Now, let's talk about the downside. 3 key considerations include losing your historically low interest rate, foregoing future equity growth, and the path from selling to buying is not without its pitfalls. The very factors that make selling so attractive, which is high demand and limited inventory, turn into challenges when you're on the other side. The market's competitive nature can make for a stressful experience as you find yourself vying for properties in bidding wars, potentially paying over the asking price, or making compromise on your must-haves. Then there's the issue of interest rates. Moving from a low interest rate mortgage that will undoubtedly ever be as low again to a new loan in today's market can significantly affect your finances. Higher monthly payments could mean reevaluating what you can afford or even delay your purchase until market conditions shift. This scenario demands not just financial acumen, but emotional resilience, as navigating from the security of a known, comfortable mortgage into the uncertainty of a new financial commitment can be daunting. So what's the play here? The majority of homeowners I've engaged with say they plan to hold on to their property long-term and keep it as a rental investment. Now, unless that was your original intent, this situation is what is known as becoming an accidental landlord, which is a consequence of golden handcuffs. The positive side is you get to keep your low rate, have an opportunity for further home value appreciation, and potentially charge a monthly rent that exceeds your mortgage payment. Let's not forget that you can always take out a home equity line of credit or use the property as collateral for a loan. As a homeowner and someone in the real estate space, I love the idea. There's a tremendous upside to this strategy, but if you currently own or previously owned a rental property, you know there's another side to this. What if your tenant stops paying you rent? Are you prepared to cover the mortgage for an extended period? Evictions don't happen overnight, so it could be a while. Keeping up with required maintenance and repairs can be time-consuming and costly, especially when it comes to major systems like HVAC or roof, among other items. But not everyone wants to keep their home as a rental, nor can they afford to. In my experience, most buyers need to sell their existing home to have enough money to put down towards their new home purchase. If you're upsizing into a more expensive home, your debt-to-income ratio may be too high to qualify, with your other property counting against you. And let's not forget what was said earlier. If you purchased during the real estate frenzy of the previous few years, it's likely you didn't get a home that met all of your needs or satisfied your wish list. As life unfolds, priorities shift. Maybe you require more space, prefer a better school district, or long for features that your home just can't accommodate. It all boils down to this one question. Is your low interest rate enough to keep you from finding the right home today? Thank you so much for watching. If you have any questions about what was discussed today, or even a different question, please drop a comment below. Otherwise, get in touch with me. My information is right here. Just shoot me a text, email, give me a call. I'm always ready to help. I'll see you next time.